All right, let's talk about your retirement future, specifically your 401k, because what's happening in the financial world right now is both challenging and incredibly inspiring. Many of you are sitting on a powerful, often overlooked financial tool that is quietly building wealth for your future, even as the markets throw us curveballs. In fact, there's a good chance you might already be benefiting from what could be described as free money and not even realize its full impact. So, are you truly on track? Let's uncover the latest insights directly from the front lines of retirement savings and see how millions of Americans are navigating these dynamic times. Recently, the average 401k savings rate achieved a remarkable milestone, hitting a record high of 14.3%. This figure encompasses contributions from both employees and their companies, and it reflects data as of March 31st, according to a comprehensive analysis conducted by Fidelity. It's a significant jump from the 13.5% reported in 2020 and indicates a strong, positive trend in how Americans are approaching their financial futures. Fidelity's quarterly analysis, which provides this valuable insight, covers a vast landscape of 25,300 corporate plans with an impressive 24.4 million participants. This record high rate is largely driven by an unprecedented employee contribution rate, which reached 9.5% in the first quarter, alongside an employer match component of 4.8%, marking the highest employer contribution rate recorded to date. This combined 14.3% rate is exceptionally close to Fidelity's widely recommended target, which advises individuals to aim for saving at least 15% of their pre-tax yearly income, including any company deposits, to help ensure they can maintain their current lifestyle throughout retirement. This recommendation is built on the assumption that you're saving consistently from ages 25 to 67. It's a powerful benchmark, and the fact that the national average is now so near this target is a testament to the ongoing positive behavior seen in the first quarter, despite broader economic uncertainties. Mike Shamrell, Vice President of Thought Leadership for Fidelity's Workplace Investing, specifically noted this continuity of positive behavior. One of the most impactful components contributing to this impressive savings rate, and indeed to your personal financial well-being, is the employer matching contribution. If you're not already maximizing this, it's something you absolutely must prioritize. Shamrell strongly suggests deferring at least enough into your 401k to secure your employer's full matching contribution. This is genuinely an opportunity for what he calls the closest thing a lot of people are going to get to free money in their life. Most companies offer to match a certain percentage of your 401k deferrals up to a specific limit. A common and popular matching formula used by nearly half of companies on Fidelity's platform is a 100% match for the first 3% an employee contributes, followed by a 50% match for the next 2%. While these employer deposits might be subject to a vesting schedule, which determines your ownership based on your tenure with the company, the long-term benefit is undeniable. Securing this employer match is not just about getting free money now, but it also strategically positions you for stronger returns when the markets eventually recover, allowing you to take full advantage of future growth. However, it's also important to understand that while a 15% savings rate is a great general guideline, there's no single magic rate of savings that applies universally to everyone. The ideal percentage for each individual is highly personal and can hinge on several unique factors. These include the size of your existing nest egg, your planned retirement date, whether you have any pensions, and a myriad of other personal financial circumstances. As certified financial planner Larry Luxembourg, founder of Lexington Avenue Capital Management, aptly puts it, everyone spends and saves differently, and this holds true both before and after retirement. Therefore, while the 15% goal is excellent, your personal situation might necessitate a different approach. Now, while the savings rate has surged, the story isn't entirely without its recent challenges. Fidelity also reported that the average 401k retirement account balance experienced a slight dip, falling 3% from the end of last year through the first 3 months of this year, settling at an average of $127,100. This slight decline, though potentially unsettling for some, especially considering that the average dip from the third to the fourth quarter of last year was a mere 0.5%, still represents a 1% gain in balances compared to the first quarter of the previous year. It's a reminder that market changes commonly lead to fluctuating balances, and such short-term movements are a normal part of the investment landscape. For a similar downturn, you'd have to look back about 2 years to the third quarter of 2023, when average retirement savings saw a 4% drop from the preceding quarter. This market volatility also impacted the number of 401k millionaires. Fidelity reported that the count of savers who had at least $1 million in their 401k accounts dropped to 512,000 in the first quarter, representing a 4.6% decrease from the 537,000 recorded in the fourth quarter of 2024. This contrasts with the record high of 544,000 401k millionaires that Fidelity observed in the third quarter of last year. The reason for these balance fluctuations primarily stems from significant market swings, largely influenced by economic uncertainty and investors' reactions to tariff policies and broader economic projections. The first quarter of 2025 saw the S&P 500, a key market indicator, down more than 4% from the fourth quarter of 2024. President Donald Trump's tariffs, in particular, had a noticeable impact on stocks and bonds, which are popular holdings for retirement savers. We've witnessed an incredibly dynamic period in the markets, marked by wild swings that make it difficult to predict outcomes. For instance, the Dow Jones Industrial Average experienced a dramatic loss of 2,231.07 points, or 5.5% on April 4, only to rebound with an equally astonishing gain of 2,963 points, or 7.87%, just 5 days later on April 9. This isn't the continuous downward slide seen during the 2008-2009 meltdown. Instead, it's characterized by intense volatility. This unpredictable environment, coupled with rapid policy changes and political uncertainties, contributed to a heightened sense of instability. Certain sectors and individual stocks were particularly hard hit by these trade disputes and uncertainties. For example, General Motors stock was down 10.47% year-to-date through June 2, while Stellantis shares dropped 25% in the same period. Companies heavily reliant on consumer confidence and extensive international operations, such as Tesla and Nike, also experienced significant losses, with Tesla down 15% and Nike down 18.6% year-to-date through June 2 before dividends. Some investors also sold off high-flying tech stocks from 2024 to take profits, creating what one analyst called a situation where what goes up fast also comes down fast. Despite this turbulent backdrop, the resilience of retirement savers has been truly encouraging. The vast majority of individuals continued to contribute to their retirement savings accounts and remained invested in the stock market. In fact, only a tiny fraction, 0.9% of 401k participants, completely stopped contributing to their plans in the first quarter, while about 22% of 401k participants and 18% of 403b participants did make changes to their contribution rates during this volatile period. Nearly 30% of those who made changes opted to move some of their savings into more conservative investments, such as bonds or certificates of deposit. This demonstrates a thoughtful, measured approach rather than a widespread panic. In fact, many individual investors saving for retirement chose not to panic sell, and quite remarkably, a significant number actually bought into the dips. Some even charged into the dip like it was Black Friday, according to financial analyst Sam Husco. This sustained commitment to long-term planning, as emphasized by Fidelity's Mike Shamrell, is often the most appropriate strategy when facing market volatility. A significant factor contributing to the increased savings rate is the implementation of the Federal Secure 2.0 Act, which began in 2025. This act now mandates that companies offering new 401k plans and 403b plans automatically enroll eligible employees at a minimum contribution rate of 3%, though it can go up to 10%. Employees, of course, retain the option to opt out of this automatic enrollment. Furthermore, under Secure 2.0, those automatically enrolled in new 401k plans will see their contributions from their paychecks automatically increase by about 1% each year until they reach 10%. Again, employees have the flexibility to opt out out or adjust this contribution rate. It's important to note that these automatic enrollment and escalation rules apply to new plans established on or after December 29th, 2022, and the Act does not compel employers to offer 401k plans in the first place. This legislative push toward auto-enrollment and auto-escalation is clearly having a positive effect on overall savings behaviors. When it comes to how individuals are investing their 401ks, Fidelity data indicates that a significant majority, over 66% of participants, are utilizing either target date funds or managed accounts. Target date funds are designed to provide a diversified mix of assets that adjusts over time to reflect an individual's age and their anticipated retirement year. Managed accounts, on the other hand, offer a more personalized investment strategy, taking into account an individual's specific goals and risk tolerance. While these options provide convenience, it's often advisable to favor passively managed index funds in your 401k to help minimize investment costs. Caution is also suggested when relying solely on target date funds, as easy doesn't always guarantee the desired returns from your retirement savings. Reviewing your investment choices to ensure they align with your long-term goals and risk appetite is always a wise step. Ultimately, the story of 401k savings in early 2025 is one of remarkable resilience and proactive saving amidst an uncertain economic landscape. While the average balance saw a slight dip, the steadfast commitment of millions of individuals to continue contributing, often leveraging employer matches and automatic increases, speaks volumes about their long-term vision. If your 401k balance isn't where you'd like it to be, remember that the $127,100 average includes savers of all ages. So younger workers naturally have less saved than those nearing retirement with decades of compound returns. The key is consistent funding, making sure you capture all available employer matching contributions, investing wisely to minimize fees, and if necessary, finding ways to free up more money for savings or even considering a side hustle to accelerate your progress. In moments of uncertainty, maintaining a long-term plan is paramount. The future remains unclear regarding Wall Street, trade negotiations, and the broader economy, and this ongoing uncertainty makes saving for retirement a dynamic challenge. However, the data confirms that Americans are rising to meet this challenge with renewed commitment. By understanding the trends, maximizing your employer match, and remaining disciplined in your contributions, you can build a robust financial future. Thank you for tuning in today. I hope this discussion provides valuable insights into your own retirement journey. Stay informed, stay strategic, and I'll catch you next time.